Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mark Hackett, Chief of Investment Research at Nationwide, to discuss the keys for success in 2023 and how investors should be positioned. Mark, it's great to have you with us. Welcome to Trade Talks.
Thank you.
You got it. And bulls and bears, they are in a tug of war this year. How do you see the fundamental factors?
Yeah, this has been largely under the radar, but bulls and bears have really been in this tug of war since right around May. We really haven't moved much positively or negatively, although it's felt like that certainly for much of the time. More recently, though, we've seen back-to-back 5% monthly gains, something we generally don't see that much. So that feels to me like we're in a bit of a period where fundamentals are taking a back seat to the technicals. That generally does happen at big inflection points in the market, which is the reason I'm cautiously optimistic over the next 12 months. Now, the fundamental picture is starting to deteriorate a little bit here, including economic growth, sales, margins, but that doesn't necessarily figure on market weakness, particularly considering what we've been up against over the last 12 months.
Explain why the market and economy are a series of divergences.
Yeah, we all know that the market's a forward-looking mechanism. Historically, it leads by about 6 to 9 months, but there's no perfect math around that. If you go back to the fourth quarter of 2021, that was consistent with what you generally see in late cycles. A lot of strength in that, that blow off top. We did see a 27% drawdown this year. That's consistent with historically about a mild recession. Now, our economics team does see a shallow recession next year, but really, I think we've probably priced in, if not all, certainly most of the weakness this year. So now we have that opportunity to look forward as a macro, engine within the market. So think about it, the macro environment is actually healthier than most are perceiving at this point. The spending data is strong, job market's strong. Most of the weakness is in survey-based data, like the PMI, which we'll get some update this Friday. But with that much negativity, particularly in the sentiment area of things, it really doesn't take much to trigger a shift in the market, like perhaps we've seen over the last several weeks.
Yeah, sentiment is nearly unanimously negative at this point. What about the bond market?
Yeah, historically, we look for the bond market to be that adult in the room during periods of market and economic stress. That certainly hasn't been the case this year. We've seen emotional swings in the bond market, not only in the returns, but also in the volatility. That's normally what you would expect to see in the equity market. We've had record levels of weakness, driven primarily just by rates. Spreads really haven't been that much of a driver in the negative move this year. Now, going forward, I do continue to see some challenges for bonds. Obviously, the quantitative tightening, which has been a real drag this year, has really only begun to ramp at this point. That's obviously going to be a persistent struggle. Second, retail investors, there's some scar tissue. We've had the worst 60-40 market since 1937. We're seeing a pretty significant allocation away from bonds for retail investors. That's likely to be persistent here because of that pain. And third, there's really the practical impact of higher rates, which is drag on earnings, but also the drag on the federal budget. These are two things we really haven't seen in the last several years, and it may not be priced in, at least in the bond market.
Let's stick with the retail investor for a moment. Why are you watching what's happening with retail investor flow?
Yeah, really for two reasons. I mentioned earlier, technicals tend to lead fundamentals, particularly at market inflection points. We're seeing a shift in sentiment and flows on the retail side of things, really before the institutional side of things. That would be unusual historically, but certainly something to pay attention to. With the retail investor secondarily, though, it's a fundamental reason, specifically supply and demand of shares. So this year has had, again, that tug of war between the tailwind of retail flows have been strong, but also corporate buybacks have been strong. That's been offset by very heavy selling in institutional funds and also hedge funds. If we continue to see that strength in the retail investor and buybacks, it won't take very much of a move from the sidelines from institutions to really drive the sustainability of the rally that I think we've seen in the last couple of months.
And Mark, when you think about what this backdrop looks like, what will the keys to success be as you look to 2023, and how are you recommending investors position themselves?
Yeah, I'm cautiously optimistic, as I said, but there are a couple of binary outcomes that I'm watching very specifically here. First, corporate earnings. We're beginning to see some deterioration in the 2023 estimates. Right now, we're looking for about 5% growth next year off of about 6% growth this year. Most people don't believe that. It looks like we're going to continue to see some pressure from margins, from revenue, but also we have rates, we have the dollar, we have the new global minimum tax. So a lot of pressure on the 2023 numbers. But again, it's a difference between that minor deterioration in the kind of 5% range versus what the bears are pointing to in that 15 to 20% range. At this point, we're leaning towards a former, but we're certainly paying attention to the latter. And the second one here is a consumer. So we've had very good data on spending. I mentioned good data on the labor market, but we've now had 20 consecutive months of negative real wages. And at the same time, we're seeing the excess savings that were accumulated during the pandemic. They've largely been exhausted now. A lot of the spending recently has been done on credit cards across the income spectrum, so not just on the lower end. So that's kind of a yellow flashing light scenario right now for consumer spending about the resiliency and the sustainability of that. Now, in terms of the market outlook, I continue to see this shift from the large technology space, which still trades at about 30 times earnings, and those earnings, as we mentioned, are going to be challenged going forward. But if you look at more creative areas like value, like small caps, like international, even quality, they trade more in that kind of 12 times forward range, and I think those earnings are probably more sustainable. So this could be a repeat of what we saw in that kind of 2002, 2006 timeframe, where overall index returns are held back by the fact that technology has to kind of grow into the valuation. But at the same time, if you're more creative and look beyond just the obvious, you could have a pretty good time in the market.
Yeah, Mark, it's so interesting. The consistent theme that I'm hearing is sustainability, right? How sustainable will the consumer be? How strong will they be? What are their ability to be able to pay back this debt that they've accumulated through the holiday season? How sustainable are earnings and margin compression and so forth? So it really seems sustainable or surprised, doing a little bit better might really be the story for 2023.
Yeah, I mean, the cliche is never underestimate the materialism of the U.S. consumer. So we do expect, as long as they have the ability to spend, they will. So the job market obviously is the big thing to watch there, because assuming that a consumer is confident in their job or confident that they can get a job if they lose theirs, they'll continue to spend. And again, the levels of debt are elevated relative to where we've been, but still quite a bit lower than they were at previous highs in the cycle.
Great point. All right, Mark, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.